Welcome to Morning Brief. I'm Julie Hyman. Let's get to the three things you need to know today. First up, the record-breaking stock rally losing some of its momentum today. Stock futures are wavering this morning after the S&P 500 and the Dow Jones closed at record highs. We'll break down whether the momentum in stocks can resume. Plus, investors are getting the latest read on the economy. ADP private payrolls data showing just 41,000 jobs added last month, a little bit less than estimated. We'll dig into the numbers and get another read on the economy at 10 a.m. Eastern Time with job openings data, JOLTS as it's also called. And President Trump says Venezuela will turn over up to 50 million barrels of oil to the United States. That announcement offered few details, but will be sold with proceeds benefiting both the U.S. and Venezuela. We'll have more on the market implications of that developing geopolitical situation. Let's get a check in on stock futures. A little bit of a sort of water treading vibe this morning after the Dow and the S&P saw records yesterday. The Dow is indicating a slightly higher open here. We'll see if it maintains those early gains. The S&P 500 futures, very little change. NASDAQ futures very slightly to the downside. So let's talk more about the big picture here and the outlook. Stocks, as I mentioned, are a little changed after we saw those new record highs for the S&P and the Dow. The Dow closed above 49,000 for the first time. So joining now to discuss more, Brian Vendig, MJP Wealth Advisors Chief Investment Officer, and Jared Blickery, our Markets and Data Editor. And Jared, I'm going to start with you here and the action that we saw yesterday into today, where at least here in the U.S. futures, we're not seeing a lot of change.
We're not, and I think it's really interesting. So the Dow is closing in on 50,000, but what I'm focusing on is the record highs that not only is the Dow Industrials hitting, but the Dow Transports. And I'm going to talk about that in a second because it relates to Dow theory. Let's just take a look at what's happened around the world overnight. And as you said, we're just treading water here in the U.S. No big deal. We got some green, we got some red around the world. But I wanted to show you what's going on inside the market. And I'm going to start with the sector action. This is what happened yesterday. I'm just going to dial a 3-day view because that's what's happened this year. We've had 3 trading days. Materials, industrials, financials, healthcare, energy, and then tech. That's the top row there. That's a pretty broad swath of the stock economy. And if you take a look inside the NASDAQ 100, and let's see if we can punch that up there, you see the mega caps really haven't contributed a whole lot to some of these gains. We haven't had a record high in the NASDAQ composite or the NASDAQ 100 here, although tech was on that top line before. You take a look at the Dow over these 3 days, there's a lot more green. Goldman Sachs up 8%, Caterpillar Industrial up almost 9%, JP Morgan up 4%, United Health, that's healthcare, up 6%. So you really see that the breadth of this rally in the Dow, and that's the Dow Industrials. Let's take a look at the Dow Transports, and that is even more green. You take a look in the upper left, the biggest stock there is Uber, that's up 5%, but UPS is up 6%, so is FedEx, Airlines doing well, United up 5%, Delta up 4%, Old Dominion, if you're into railroads, that's up 7-8%. So according to Dow theory, you want to see confirmation in the stuff that is making the products for the economy and also the companies that are shipping them. And that's what we're seeing right now. And as I said before, we're not seeing the participation of the mega caps right now, but that's just fine as witnessed by the records in the Dow and some of these other indices, including the S&P 500.
Yeah, I mean, listen, we're 3 trading days, about to be 4 trading days into the new year. And if you look at the groups that have done the best so far, I mean, to be sure, it's early, I get it. But it is interesting to see it's materials, it's industrials, it's financials and healthcare. It is not tech, notably, which has been sort of lagging. So interesting here. Brian, let's bring you into this here as we look at this setup now for this full year. The beginning of the year characterized by some turbulence on the global stage, but not really in the markets. And that's been a disconnect that's been going on here. Do you think that will continue?
I think over the course of the year, I mean, we should expect a rise in the markets powered by earnings. And I think that's why there's been a disconnect in the short term, is because the earnings projections have been pretty robust for next year, and also a larger contribution coming from areas outside of tech, which I think speaks a little bit to this repositioning. And if you take a step back from Q4 results in the market, that trend started to happen. And I think also with some comments this week from NVIDIA and thinking about the super cycle that's been discussed that could be ahead, I think investors are just hedging a little bit to say, look, if there's a wane in spending in tech, if the productivity gains are not there coming from tech, then they're looking for value in other areas that honestly are priced a little bit more attractively right now.
I'm curious if energy is one of those areas, right? Obviously, there's a lot going on there right now with the seizure of Nicolas Maduro, with the president talking about the U.S. getting access to some of that oil, U.S. companies beyond Chevron maybe getting access to the assets there. I don't know if they want them, but there's this whole back and forth about it. Do you even want to go there when it comes to energy, or is it not worth the uncertainty around it?
Sure, I think it depends on what part of the energy complex you want to invest in. I think comments from the administration makes it very clear that one aspect of a way to keep inflation down as part of the overall economic goals is to drive oil lower. And I think the administration is looking to add supply as part of this reinvestment in Venezuela, but also just global relationships with other trading partners when you think about LNG exports as well coming out of the U.S. So I actually prefer servicing the energy complex than investing in exploration. I think that's the way to hedge it. But I also think, bigger picture, if you look at the energy complex and the connection to utilities, and also the cyclical trade that we're talking about, in an environment where maybe inflation isn't going to run as hot as we think, the Fed is more neutral, maybe we'll get a rate cut or two this year, that plays into the utility sector and energy supporting utilities, because utilities need energy to support AI innovation, the ongoing demand. And that's why looking at companies like EXE, for example, based out of Louisiana, they're supporting natural gas output that is being bought up by the utility industry, because you're not going to be able to turn on nuclear power just with a switch.
Right. Yeah. So in other words, looking not necessarily to big oil, but to big natural gas, maybe. Jared, I know you're looking at some of the action that we have seen in the XLE and some of the technicals also on that ETF that tracks the energy group.
You bet, Julie. Let's dial up the Wi-Fi Interactive once again. This is what the energy complex did yesterday. Most of these are stocks, but I'm going to pull up, as you said, XLE. This is large cap energy. I'll show you the trailing year, and you can see that's a lot of sideways action there. And in fact, if I pull up 5 years, you're going to see a lot of sideways action there. So this is just a very long-term consolidation. Here is a max chart. This goes all the way back to the beginning of the century, basically, the entire history of XLE. What we're going to see here is we are right up against levels that we have been testing for over a decade, almost 2 decades now. 1, 2, 3. But what's different about this time is we are consolidating near these highs, and it looks like we are set to break out. And I would mention too that crude oil does not always rise and fall with the energy stocks, but if crude oil were to put in a meaningful bottom and start to rally with the entire commodities complex, and there are a lot of people saying that we're in the early innings of a commodity super cycle, we're not seeing we're not seeing crude oil participate just yet, but if it did that, then I think you would see XLE start to really break out and take off in a way. What's the old saying in trading? The longer the base, the higher in space. So if you believe in that maxim, there would be a long ways to go to the upside. But this has been a very slow going pattern in its development, so it could take another few months. It could even consolidate for another year.
Yeah, and it's interesting to hear Brian talk about, not wanting to be necessarily in those big oil names, but being in the gas part of the equation. I do want to turn to tech for a moment here, Brian, because we've got CES going on. We keep getting this steady drip of news, particularly from NVIDIA, right? Mm-hmm. So the latest, it sounds like they're seeing demand for their chips in China. They're ramping up production for that. This after, of course, they revealed the production is going for the Vera Rubin system. But how do you think, you said, and broadening seems to be one of the early buzzwords I'm hearing. We heard it a lot last year, but I'm hearing it a lot already in 2026. But what do you do with tech in the meantime?
Sure, I think tech, we still believe that AI innovation trend is there over the course of the year. But I think investors are being a little bit more fickle to measure the productivity that's going to come from that. How much is that going to drive operating margins and obviously net profits? And if you think about what NVIDIA is talking about for this year, they're forecasting a cycle, another super cycle that's going to play out in the second half. And to be fair, the $50 billion of revenue for the potential of having those chips going back into China are not in their results.
Right.
And so I think investors are thinking about that. And I would say downstream, it's more about the software providers. I think it's more thinking about the picks and shovels still in the industry. And last year, we didn't really see a lot of action from software. But if you're going to try to measure productivity and getting gains from an enterprise perspective, they definitely have to participate. So I think we've just looked at the last 10 years of growth performing better than value, investors just making sure they're not paying up and waiting for those results to get that indication. If those results start to come forward and we get some of those agreements on trade around chips, then that's where, I think tech is still in favor for the second half of the year to participate.
And will value also be playing, or do you think, it sounds like maybe not, I don't know.
Well, I think the way we're thinking about it is that it makes sense to be even weight that growth versus value conversation. But it's not so much just purely on those two style boxes, because it's also looking at large, medium, and small companies. And in this environment, when we're looking at these earnings forecasts, if folks are reasonably outlooking profits appropriately, we should see a pretty good uptake in profitability numbers for small caps, mid cap, as well as some of these cyclical or value areas. Now, granted, financials, have jumped off the page, for the start of the year.
Right.
And I think that has a lot to do with the landscape and the activity that investors are expecting. At these levels, it's probably fairly valued. But as we see a steepening yield curve, as we get more on M&A and potential IPOs, I think those types of activities are going to push more into that value camp, while investors are still, assessing that super cycle on tech as things play out.
Gotcha. Brian, thanks so much. Good to see you. Appreciate it. Coming up on Morning Brief, we'll bring you today's top trending tickers and count you down to the opening bell. And thanks to Jared, of course, as well. We'll be right back. Time for some of today's trending tickers. We are watching Paramount, Skydance, Strategy, and Discord. First up is Paramount. Warner Brothers, yet again, rejecting an offer from David Ellison's company. The media company's board said the bid provided insufficient value and has doubts on Paramount's ability to close the deal. Paramount's argued that its offer for the entire company of Warner Brothers is superior to that of Netflix and more likely to win regulatory approval. Netflix said today it has already submitted its regulatory filing and is engaging with antitrust authorities. As this drags on, we're seeing sort of diminishing effect on the stocks as we get these types of headlines. All three of them are changed less than 1%. Next up is Strategy. Michael Saylor's Bitcoin giant gaining after index provider MSCI shelved its plans to exclude digital asset treasuries from its stock market indexes. MSCI said it would maintain current index treatment for digital asset treasuries. However, it did signal plans to launch a review on how those companies should be treated. This amid questions over whether Strategy was going to go into those indexes, and that would mean probably a bump for the stock. And finally, Discord. The chat platform has reportedly filed confidentially for an IPO. Bloomberg News is reporting the company is working with Goldman Sachs and JP Morgan for that listing. Discord has more than 200 million monthly users. It's popular with gamers and programmers. The company was valued at about $15 billion as of a funding round from 2021. Well, the deep freeze in the housing market might start to thaw in 2026 as mortgage rates creep down, but that doesn't mean there will be a wave of baby boomers moving and freeing up supply. Meredith Whitney, Advisory Group CEO Meredith Whitney, is joining us now with a closer look. Meredith, I know this is something you've watched very closely. I was just checking out the mortgage rate data coming out today from the Mortgage Bankers Association at 6.25%, the average 30-year fixed, down from 6.32% the prior week. But I know you've got your eye on some of the sort of bigger picture trends that aren't necessarily supportive of the housing market this year, right?
Yeah, so rates are part of the equation, but home prices are an equally, if not larger, part of the equation. So that really is the sticky point in affordability. So you can lower rates, but if prices don't come down, affordability still is very problematic. And there's another issue too, which is there's very low inventory and there's very low sales volume because they're a very low inventory. So 60% of existing homes are owned by seniors, people over 60, and they're not selling. So they're living in their homes for longer. They are aging in place, which means there's less property property on the market and less inventory, churn, which keeps prices high. And the other thing that happens is that when seniors and homeowners are facing the same affordability issues that so many Americans are, they are increasingly tapping into the equity in their homes. So there's 36 trillion of equity in homes, and I estimate there's about 26 trillion in tappable equity. Only just over 400 billion is tapped today, and that's again very low relative to historic basis. So if you looked at 9 trillion of equity back in the where the housing crisis occurred, there was over 700 billion of home equity available. So the dynamics are not going to improve anytime soon. So last year, 2025, there was just over 4 million in existing home sales, and the estimates this year are a little bit higher, but not much. So I think the existing home market stays gummed up, and the fastest growing loan category is home equity. We think that there's a home equity renaissance going on, so that more and more people are going to tap into the equity to make ends meet. So increasingly, more people are using home equity as a cash management vehicle, whereas historically they've used home equity for home renovations. That's down. Cash management is up. So you get into home affordability, which I think is going to be a central issue of midterm elections, and that's really going to focus then on new home building, and a lot of it then is going to focus on manufactured homes, home building, because that is so much cheaper than the site-built homes.
Okay, so there's a lot to unpack there, Meredith. So let's slow down for a second and do that. We've talked before about the home equity boom the loan boom that you're predicting, and some of the potential beneficiaries of that, from companies like a SoFi to a Rocket. How do you think that's going to play out this year? And do you think that traditional finance will also get a piece and benefit, or is it just that it's so much a smaller part of their business that it's not as meaningful for them?
Well, Julie, you nailed it. So Bank of America is the biggest home equity lender, but it's a tiny part of the business and not one they really focus on. One they extend to their high net worth clients, but one they're not interested in building that line of business dramatically. So it's really the non-bank players that have been the bigger growers. And so you had Rocket and SoFi be big in that space, and Rocket more of a home equity play than SoFi. SoFi we're recommending because it's an originate and sell model. So they've got so much interest from private credit wanting to buy their loans that they can originate and then immediately sell, which turns them into a much higher volume, higher margin play. But both stocks benefited last year. Now, both stocks were up 85 and 75% respectively, Rocket and SoFi, and they benefited from the fact that there's a very robust pipeline of home equity companies that are set to go public. So Figure went public in September of 2025, and both Rocket and SoFi benefited from margin expansion because of that deal. So they're about what we estimate to be a half a dozen home equity stocks set to go public. These are private equity funded companies, and private credit buys their loans. So private equity needs an exit strategy. They're on deck to go public. So there's a lot of momentum behind this sector, and there's a lot of demand from consumers who want these loans. So that's why we think it's a home equity renaissance and what we call a fat pitch investing opportunity here.
And by the way, Figure itself has also done pretty well since its IPO. The stock is still, I think, more than double the IPO price. I want to get into manufactured a little bit, because this is a fascinating area to me. And when we talk about manufactured, people are watching, we're talking about what we used to call prefab housing, right? You build it somewhere else and then you take it to the place, or it's easily assembled. I mean, like, people like Martha Stewart are now designing these kinds of houses. And in the past, I think you could argue there was something of a stigma around them. Does that go away in 2026? Do we see a manufactured housing boom?
Julie, I'm so glad you're as into manufactured housing as I am, because I could talk about it all day long. people look back on the pre-1970s as like a trailer park type manufactured housing. Manufactured housing today they're really nice. So not only are they oftentimes 25% of the price, but they're incredibly not, I would say high end, very, very nice. So what's interesting about this and why we think this is also a fat pitch opportunity is there are as little as 100,000 manufactured shipments annually. It bobs around right 100,000. So when you move manufactured housing, there's a requirement from the 1970s, which is a chassis requirement, where you have to move the manufactured home on a steel platform, and then you have to install it with the steel platform. So both the House and Senate bills repeal this really outdated structure, this chassis mandate, and that would lower the price of manufacturing by an estimated additional 25 to 50%. And importantly, the Manufactured Housing Association on Regulatory Reform thinks that it will increase shipments from 100,000 to 500,000. So that's obviously a quantum increase, and what it would do to companies like Champion Home, Sky, would be massive. And there's Cavco that benefits as well. So these are quantum shifts in a business environment and volumes that could happen with the stroke of a pen from reconciliation from the House and Senate. And the House and Senate, by the way, are motivated to pass this in the first quarter this year. And then of course the White House wants to be heavily involved in affordable homes too. So at the center of this affordable home, I think, is the manufactured housing stocks.
And so basically this is an election issue in your view because of the whole discussion around affordability.
Without a doubt. This will be the domestic election issue for the midterms.
Meredith, thanks so much. You got to go peruse those Martha Stewart prefab homes. They're definitely not what you imagine when you think about it. Thanks so much for coming on, and we'll take a look at Champion Homes as well. Appreciate it. Coming up on Yahoo Finance opening bid, our executive editor Brian Sazzi is planning on upgrading from an apartment to a manufactured home. Right?
Actually, I should say, Julie, that entire segment inspired me to buy a tiny home, move to the woods, retire, and forget about life. I'm not even going to send you text messages anymore, Julie. I'm just going to retire, tiny home, prefab, cold plunge, and I'm going to be a hunter. I think it's a great idea.
I don't believe a single word that you're saying.
Well, maybe you should. I'm full of surprises, and we're going to keep the surprises going on opening bid, Julie. I know you like that segue. I'm going to simply break down off the top 3 reasons why the stock market's at a record, and it doesn't have anything to do with AI. Okay, well, I look forward to that very much. And I definitely don't think we'll see you in the woods anytime soon. Yeah. All right, that does it for morning brief. We got much more ahead on Yahoo Finance.